Welcome to Financial Ginger. I'm your host, Jacob Johnson. The insurance department has repealed Bulletin 225-8. What the heck does that mean? It means Utah Code 41-12A-301 was repealed. That doesn't mean anything. But what that does is it changes the recent bill HB 47 that was recently passed, March last year, so almost a year ago, that made it so where if you didn't have insurance on any car that was registered in Utah, you could get fined for it or get your registration revoked on your car. So HB 47 was changed by the official bill. It was passed on February 12th, so just a couple weeks ago. And what that means is if you have a seasonal truck or seasonal sports car that you only have insured part of the year because it's a winter truck or sports car that you only drive in the summer, you won't get fined for that anymore. In fact, I had a client that got fined $400 by the DMV for a vehicle that was uninsured for 6 months because it was a seasonal vehicle. So great work. We're excited that the Utah legislature changed that. Write to your legislators and let them know they did a good job with patching HB 47 S1 to change that law. So if you have interesting insurance news or stories, leave a comment or email them to me, thefinancialginger@gmail.com. But that's not the important part of today. Today, the most exciting thing is Josh Duke. Josh was born in Idaho Falls and raised in Eagle Mountain, Utah, where he's lived for the past 20 years, long enough to know what Eagle Mountain was like when it was still wide open and empty. I used to go shooting out there. And now there's houses where I used to go shooting where you probably went shooting as a kid if you went shooting. He studied business and economics and has spent the last 4 years as a licensed mortgage broker with remarkable home loans. He learned early on from his dad, who built his business by treating clients like family, that relationships matter much more than transactions. That's how Josh operates today. Josh is a self-proclaimed finance nerd because dollar signs make numbers so much more interesting. Josh and his wife Autumn met in high school and later both served Christian proselyting missions for the Church of Jesus Christ of Latter-day Saints in the Washington, D.C. area before they got married. He's a gearhead, a percussionist, and probably doesn't know that I looked this up, but fluent in American Sign Language. Is that true?
Yes, sir. Yeah.
That's cool. Yeah. I know like 2 signs. I know fear and name.
Hey, there you go.
That's all I need. Oh, and I know a bunch of colors like orange. And violet and green. Blue, yellow.
Hey, you know way more than you thought.
I know a few things. Yeah. It's exciting.
Yes, sir.
Welcome on.
Thanks, man. No, I've been super looking forward to this. So
yeah, I've been excited
awesome.
since we met and we connect. Well, because we found out that my office had been doing insurance for you and your dad for so long. It's like, oh, whoa, what's the connection? Right. Yeah, meeting at different events. So I'm excited to talk about loans and home mortgages.
The most exciting topic.
Loan? What should people know about home loans?
I'm about to crack all the industry secrets. Pull the curtain.
Pull the curtain back.
Oh man. No, I think it's a topic that unless you need to know,
you don't need to know.
Why? Yeah, you don't need to know. Like I remember specifically having conversations with my dad. So when I first got into the industry, I knew nothing. I knew very little about what mortgages were, how to get one, what the point was, and kind of the nuances that go with it.
I still don't know anything about them.
Well, yeah. Well, it's like you just, you don't
pay them.
Yeah, right. You got to make the monthly payment. If you don't know, you don't know. And I like I said, I remember having conversations with my dad, and because he's been doing it for so long, you almost get jaded, you know, in whatever industry or profession you're in, you kind of forget what people don't know.
Yeah.
Who aren't who don't do it every day. You know, so the average home buyer, they get a few mortgages in their lifetime. They get their first one, and on average, one every 7 to 10 years, they'll either refinance or buy a new home, right? So that's like a few. So you don't really learn that much about them.
No,
right?
Which is closing costs.
Right. Which is fine. Like but that's why having a trusted mortgage advisor becomes extremely important because you can go to the online lenders, you know, you can put in your information on some online form or whatever. You could get a quote from someone, but at the end of the day, once you close, they don't care.
Yeah.
They're never going to reach out to you. They're never going to make sure that, you know, your escrow account still looks good and answer any questions that you have. I get clients all the time that I closed over a year ago. That are still calling me and saying, hey, I got this thing in the mail, or hey, I got this notification about my escrow account. Like, can you look at this for me? Absolutely.
I had the worst thing happen to me. So I just got right. It's that time of year. Everyone's getting their escrow. After I closed on my home I'm living in now, the next year my mortgage got sold over to Rocket Mortgage, who it was with. I mean, it got sold like a week after I closed, but then it got sold 8 months later to Rocket Mortgage. And then I got a refund check for like $1,500, and it's like, you have too much money in your escrow. And I'm like, there's no way. Well, guess what happened this year, right? The next year I get to know, oh no, your escrow's underfunded. Almost exactly $1,500. And so they suddenly lump on an extra 147 or whatever the dollar amount is to add up to that amount over the next year. And I'm like,
wild.
Why did they send me a refund check a year ago just to
I've been getting,
say you don't have enough? That happens so many people.
Well, I've been getting way more questions about that too. And I've seen stuff on social media that got posted by people. They're like, hey, this happened. Like, what's going on? What do I do? Check your escrow accounts always.
Yeah, you can check them.
It's on your monthly statement. You should be checking that, especially around the times when those are due, when taxes are due, when your homeowner's insurance is due. Like, you should absolutely be checking those. Make sure that the numbers line up, because taxes go up every year, even if it's just $100 or something like that. Insurance premiums have been going up as well. Like,
unfortunately.
You should be, right. You should be checking those though. Like, be on top of it. Doesn't take long. And if you need someone to check it, I'm more than happy to look at it, or any loan officer, whoever it is that you worked with, should be more than happy to look at it for you and make sure that. I had a client that they said that their escrow account, this is what happened. Yeah. Ridiculous story. Loan got sold to another servicer. They didn't realize that it was a townhome. So you only need an HO6 policy, right? Just to cover the interior. The HOA covers the structure. They didn't read the documents very well. And so then when they were reviewing it, they said, oh, well, you don't have a sufficient insurance policy. We are going to force place an insurance policy and pay triple what the premium should have been. And they paid it out of their escrow account for an HO3 policy, a normal homeowner's insurance policy for single family homes, but it's a townhome. Yeah, they don't need that. And he was like, what the heck is going on? And so he reached out to me because I had done a mortgage for him later for a different property. And lo and behold, at that point, you just have to call your mortgage company. Yeah, I said, call that servicing department, call the lender that you're making your payments to, and get a hold of the actual loan servicing department and say, hey, this is wrong. It says that you force place this insurance policy. The original one I had is sufficient. Go back and look at the loan documents. You need to look at the HOA's insurance policy. Sometimes if you just log into your HOA portal, you can download a copy of the master insurance policy. That's what you need. Send that to them as well and be look, there is insurance. Because I've had that happen where people will send me a lender note and the lender's like, we need proof of insurance. And I'll send them back an HO6 policy because that's what they have, right? For a townhome or condo. And they'll say, oh, this isn't enough insurance. Well, they only have $100,000 of coverage. Of course, that isn't enough for their $400,000 townhome. Right. And so they'll say, that's not adequate. I'm like, oh, well, this is an HO6 policy. It's amazing how many of those mortgage servicing companies don't know the difference, and it's fine. It's not fine. It's not fine. But they're a huge corporation. They're servicing millions of loans. Probably they're not really going to take the time, but that's why you as a homeowner just need to check it. It doesn't take too long. Hopefully it's not super complicated. Well, because when I got that refund check, I could have probably looked at it and said, wait, my taxes are this much just because my first year taxes were lower. Right. Because I just bought the place. It was a brand new build. And so the first year of taxes, they based it off of the previous year's adjustment, which was saying at that point, it was just vacant land. It was only worth $80,000 or whatever. So the taxes were only like $400 or $300, whatever stupid small amount. And then the next year, the taxes were like $2,300. And then it adjusts. And that's where that $1,500, it's like, that's so silly. I could have just called them and said, put this check back in my escrow. I don't want the money. And then, but your loan officer, this is what we try and do when we work with clients that are doing new builds. That happens all the time. Because the county hasn't verified yet, because the county does tax assessments once a year, usually. But when they're doing new developments, sometimes it's more often that, but they won't verify that hey, actually there's a single family home now on this. So the property taxes are going to go up because it's not just raw land anymore. Now the tax amount is going to go up. Your loan officer should be checking that when you do the original loan. You can tell because when the taxes are way too low. $300. Yeah. And so they're like, no, we need to actually escrow higher. There was a builder that shall not be named that there was a huge lawsuit that's been going on with, not just in Utah, but a bunch of other across the states where they've done that. Where Google it, leave it in the comments for everyone else. Yeah. But we won't say it here. No. But that's been an issue. They underestimated knowingly or just out of negligence that tax amounts weren't right. And so people's payments were jumping up hundreds of dollars a month, and they were like, what the heck?
Well, yeah, if they're able to base it off the raw land value and it's $200 a year in taxes, and then when it's finished build, if it's a cost, right, like I'm talking like $400,000 homes that are $2,300 in Utah. Depending on the area you're in, obviously taxes can be higher. But if you're building $1 million home,
it's a huge difference.
Or $1.2 million home, and suddenly the taxes are $5,000. Yeah, your property taxes might jump $400 in 1 year.
Right.
And if you're under escrowed, it might make your escrow jump $800 a month. I actually had someone that happened to, where they called me, they're like, my mortgage company told me my insurance rates went up, and that's why my escrow jumped $800 a month. I'm like, your insurance premium did not jump $9,000 this year. No, they were also in a high wildfire risk area. So there's a new tax thing that Utah's doing that just started that I'll explain more in another episode. But certain people that are in higher risk fire zones are getting a small tax to be used to subsidize fighting the increased fire risk, to hopefully make everyone's insurance costs go down. And they're also forcing insurance companies to use state regulated fire risk maps instead of their own maps that they draw, which is interesting, because you'll get one place where someone will say this is an 80 risk score, which 80 is pretty high, right? 90 is extremely high. And another insurance company will say it's a 93 risk. I'm like, why is this company saying it's an 80 risk? This one's saying it's 93. And usually the insurance agents don't know that. They just say ineligible or eligible. But it's like, why is this one carrier so much more expensive? Anyways, it drives me nuts. So I'm hoping that'll be good. But what had happened was their taxes had jumped that way. And so they were being under escrowed in that. And yes, their mortgage, their insurance, home insurance did go up, but it was like $400, right? Which obviously was a lot, but no, it wasn't $800 a month. It was this under escrowed problem for their taxes.
It's true. So that's just a plug as a friendly reminder, especially this time of year. Not sure why it's this time of year. Taxes were already paid months ago, back in October, November, but homeowners insurance premiums, especially if you bought, because insurance renews annually on the anniversary of when you bought. So assuming you didn't change policies or whatever. So just check it.
Yeah, and just be aware of it. The other thing that I tell people, right, so like that's new builds. Yeah. Right. New builds, it's really important to make sure your escrow property, which, right, a lot of people are like, oh, well, how am I supposed to, like, I had a real estate agent on one time. He was like, oh, I need to remember that because I was saying something about a certain type of insurance. And I'm like, no, you don't. Yeah. You just need someone that you trust you can talk to. 100%. Right. I don't need to remember all this stuff about escrow. It's just talk to Josh when it happens, right?
Yeah, like 100%. Yeah.
Well, right. I'm in the middle of a 1031 exchange, and I just said, hey, hit me up at the end of March and we can talk numbers, because I'm going to close in April at some point. So
totally.
It'll be good to, so I don't need to worry about all that stuff because I know that you'll do it properly.
Yeah. Right. Yeah.
So
it's a nice thing about having a trusted professional in your corner. So
yeah. And that's why I tell people as well. It's like, I'm going to teach useful information, right? The people that I have on podcasts but you don't need to remember all this stuff. I have a financial planner.
Goodness, no.
It's no trusted professionals. And then you can ask yourself the question, do I trust the professional I'm working with?
Yeah.
And if you don't, then find someone else. If not, maybe you just don't know your professional. Talk to them more.
100%.
Yeah. Super 100%. Important. Wow. Fun. Escrow situations.
God, yeah. It's super fun.
Quick pause. Financial Ginger is sponsored by me. If your insurance renewal just went up and you're not sure why, that's exactly why I exist. I'm an independent insurance broker here in Utah. I represent nearly 25 insurance companies, so I can compare their rates and coverage side by side and show you your options clearly. When you call my office, you get a real person, no robot, no menu, just a real conversation. Email jacobinsuresutah@gmail.com or call and text 801-216-8444, and I'll review your coverage personally. All right, let's get back to the episode.
Yeah, well, and that's the difference between, right? Someone might be like, oh, if we can roll the numbers, you might be able to get under a certain loan to debt ratio to be able to close on a property. But it's like, yeah, but what if that's unethical? Like
the builder who shall not be named, that was part of the issue. It was like, hey, taxes are way underestimated. And people were scooching by being able to qualify on their debt to income ratio. They were just below the limit.
40% or
But then if you quadruple,
42%, don't they?
It depends on the different loan types, but it's a little higher than that usually. But barely qualifying, and then when you adjust the taxes,
$400 a month tax.
Well, when you quadruple the taxes, now they don't qualify anymore, and so now they're stretched even more on, and just cost of living is going up on top of that, and now people are a little worried. So understandably so. Anyway, it's been a whole debacle. That's what going down.
Fascinating than I thought.
Yeah. So
you're talking about how loans aren't that interesting. They're super interesting.
We'll make them interesting.
Wow. Okay. So, I'm not even sure what I'm asking. This is just interesting. I want to continue this. Well, what other mistakes do people make when they're besides like escrow problems? Like, are there other errors that a loan officer might make? Or
that is a good question. Yeah. Let me think about that. I know that a lot of times people, we'll take this for example. I had a client that reached out to me just recently, and they said that I don't remember who, a bank or credit union or whatever, just someone that they walked into, they didn't count their income very accurately.
Oh.
But he has kind of a unique situation. He's a diesel mechanic. And so he gets paid every week rather than every 2 weeks or once a month or salaried or whatever. But he also gets a lot of overtime. He gets other stipends like a tool stipend, phone stipend, things like that. Other outside of normal base income.
He's paying them and then getting reimbursed.
Something like that. Yeah. But and then also it was right around the holidays. And so he had taken some time off. And so he didn't have like 2 weeks of paychecks because it was the holiday, right? Christmas and New Year's. He pretty much took those 2 weeks off. And so we went to this other lender. It was, oh, well, we can't really count very much income. And they were way undercutting what he realistically makes. And so he then came to me. I got referred to him by his financial planner, said, hey, reach out to Josh. He's a broker. He's got more than just one lender to look at your scenario. I've got dozens of lenders and banks that all they do is mortgages, and that's a huge benefit
and all
too.
All they do is compete for you. You make
seriously
dance monkey.
Yeah, right. No, but they don't do credit cards, car loans, personal loans, whatever. They don't do any of that. We just do mortgages. So the process is dialed in, the underwriting is dialed in, and I've got access to all of these different lenders so that if one lender doesn't like a scenario or an application, I'll just take it somewhere else and say, hey, what about you guys? You know, there are some loans that the guidelines are regulated, like conventional Fannie Mae, Freddie Mac, if you've heard of those, FHA, VA. They all have a standardized underwriting guideline book. But some might look at scenarios slightly differently, right? Sometimes you just get an underwriter that woke up on the wrong side of the bed and is just hell-bent on
like,
making your life difficult.
Yeah.
But so we looked at the income, and I was a little more logical, I think, about it, and said, hey, well, we can see here that there was a little bit of a gap because you were gone on vacation. That's totally fine. Look, we'll just go back a little bit further and let's look at your total year-to-date average. What does that look like?
What type of loan is that? Because the reason I ask is because when I've gotten my loans traditionally, because I'm self-employed, 1099, I run a business. Here we go, Financial Ginger, shameless plug for the podcast you're watching right now.
I love it.
But they've usually based it on the average of my last 2 years of taxes.
Yes. Yeah.
So was he trying to do a different type of loan, or was he just trying to qualify recent income to make it so he could get a higher loan because he was making more money than, or I don't know. I want to ask about that.
Yeah. So that's the way that they do it is very differently depending on the type of income that you have. So if you're self-employed or 1099, then we're going to look at your last 2 years of tax returns. Unless you've been in business for 5 years or more, then we only have to look at the most recent year, just your recent tax return.
That's helpful. I think I just hit 5.
Yeah, right. There you go.
Nice.
So, so you either do that, or if you are an employee, and this is where then it kind of branches off again. If you're full-time, if you're salaried, we can just take it at face value. We don't have to average out anything. If you're full-time at like 40 hours a week, and that's kind of the standard for mortgage lending is about 40 hours a week. If you're at 40 or more and your pay stubs are consistent with that, 40 hours or more, we can just take, your 40 hours a week times it by your hourly wage, and we calculate your monthly income from there. If you're less than that, if you're like part-time or whatever, or variable hours, or you're not consistently getting 40 hours a week or 35 or whatever, but if it's not consistent and very consistent, then we might go back and average it either over the last 12 months or 24 months.
Oh, okay.
So but that's where a lot of nuance comes, that if you don't understand that as a loan officer, you might miscalculate someone's income. So I got business that would have probably gone to this other lender if he just calculated it. I don't know if maybe that's the way his organization does it, his lender, but the way that we do it and the way that our underwriters look at it, we're
being able to justify that to an underwriter that's looking at a loan is super important.
And that's the thing that we have this conversation with clients. It's like your financial situation better than anyone, but an underwriter doesn't know you from Adam. They know nothing about you.
To get to know you.
This is the joke that I make. Yeah. I make the joke that an underwriter is going to upfront assume that you are an illegal drug cartel runner and all of your money is laundered. And it's all fake, and you have to prove to them otherwise by showing documentation, by showing pay stubs, a verification of employment, bank statements to show you have money in the bank. You have to show that there aren't weird deposits. Like if you have like large cash deposits in those bank statements, you're going to get asked about that. Things like that. So the underwriter doesn't know anything about you. And our job as a loan officer is to work with you. We're the kind of the middleman, the third party that understands both sides. And we're going to take your information and all of the necessary information and anything, sort through it all. Anything that isn't necessary or would bring up unnecessary questioning to the underwriter, filter all that out and just show the necessary stuff that they need to make a decision on your file. So that's that's pretty much in a nutshell what we do, is helping people to understand the underwriting side of it, the guidelines, the requirements to qualify for a certain loan, and then show what we need from your situation to fit that box, right? Or for whatever loan you're looking at, right? Because those boxes look very different
depending on the loan,
depending on where you're going. So yeah.
Wow, that's interesting to me. Just because like thinking about how I've qualified for loans and some of the weird underwriting things I've had to go through, or like one of them, I used a different tax preparer for 1 year and he just wrote off some things in a different way on my tax form than a previous tax person. And then I went back to the same. So I've used the same tax person for since I was a kid. He said 1 year, I let a friend of mine do it, and he didn't do it wrong by any means. He just did it a little differently, like the way he filled out some of the forms and the way some of the line items were worded. And that of course happened to be the year I applied for a loan. And so like these two tax returns look so different. And also the way I was waging myself was a little bit different in those 2 years. And so like, what's this discrepancy in wage versus a capital distribution for ownership in your business? And it's like, what is going on here? And then it also looked weird because the company I was using for my payroll changed names. They were acquired by someone else. So the payroll company that made a little W-2 type form for that wages was different for both years. Like, it looks like two different entities have been paying you. And I'm like, like it was interesting. I got approved obviously in the end, but it was just, it was so much of a headache to like explain all these things to people. It's loans are not fun.
Yeah, right. Well, they
are fun.
Yeah, right.
It's fun to buy a house.
Yes, totally. Oh, yeah. Like a mortgage is one of those necessary evils. Everyone wants a house. No one wants a mortgage. You know, and so we try and make that as simple as possible and painless as possible. Doesn't mean it's not going to have some sticking points and some stress, but that's where a good loan officer and where we try to differentiate ourselves is going through someone's whole scenario. Especially, I've seen tax returns over 100 pages long from people, and it's okay. We're going to go through this all. We're going to figure out what an underwriter might flag, what might they ask more questions about, and get the information from you up front. So then you're not already under contract on a house, and now you've got a deadline. And you're like, well, we have to get this figured out like tomorrow because we're running out of time here on our deadline. We have to close on this house next week, and we don't have it clear to close. What's going on? We lose our earnest money. Like, nothing keeps me up at night sometimes. I probably worry about clients' earnest money more than they do. So, but that's why we just make sure we get everything cleared up front as much as possible, get a clear picture on it so that when we do go to the underwriter, it's like, hey, and going to bat against the underwriters for our client, how many times I have quoted to underwriters their own underwriting guideline from the handbook. You can Google it. You can look up Fannie Mae selling guide or FHA 4000.1 handbook.
And it's like, well, I don't really like this. And it's like, it says right here this. What doesn't fit that requirement? Oh my gosh.
Yeah. But being able to just go to the underwriter and not being afraid to have that conversation with them. Not that the underwriter's like, I don't want to frame them as like bad guys, but sometimes it takes a little bit of persuasion and explaining to them, hey.
Well, they're trying to defend the money. They
have a fiduciary responsibility. Absolutely. And it's just matching expectations and matching information. So then get to a conclusion.
Here was a weird one. While I was applying for that same loan, I had investments across 3 different accounts because I wasn't sure if I liked Fidelity or Schwab more. So I had money in both. But I also had money in a Robinhood account that I just had since I was in college, right? I was like, well, I know I should be putting a little bit, $50 whenever I could, right? Yeah. Like it didn't have much money in it. Well, I'd done some silly crypto stuff with some of that money because it's my play money. Yeah, crypto.
We love crypto. The last,
but I sold some Doge coin
nice.
And I made a couple $100 off of it. And I put it into some energy development company like EPD, and the way that Robinhood handled the distributions from that company, it didn't show up as a normal distribution or dividend. It came in as I got this form in the mail that was like ownership interest, like stock. It was weird. And Robinhood sent it to me every single year until I closed that account. And so they were like, hey, it looks like you're part owner of some huge company. And I'm like, I own like 1.3 shares of stock that's worth like $47, and they paid me a 3.2 cent dividend. Like, so I had to go and get that paperwork because it wasn't on the Robinhood forms because it was done separately because of the way Robinhood. So just like this weird thing about the way Robinhood handled this one dividend was this whole huge ordeal for the loan company. It's
wild.
Like, wow. But right, obviously, if I am part owner in some ginormous energy company, that's obviously worth the loan company caring about. It's like, wait, are you some massive public figure? No, I'm just a normal dude, you know, like, so that was really funny too.
I am an owner in a oil company, and
exactly. It was that sort of thing.
So funny.
There was EPD. There was a second one as well that just happened. Both of them did weird, and I got anyways.
Wild.
Thankfully, I don't have them anymore. I closed the Robinhood account. I decided I was a big fan of Fidelity, so I got all my stuff Fidelity.
There you go. There you go.
But they're all good companies. Just except Robinhood. Don't do Robinhood. Anyways, there we go. Who do you like? Anyways,
wild.
So yeah, I find loan stuff so interesting because it's like, oh, like the weirdest things matter, but it does matter, right?
Yeah,
like
it can.
Yeah. Do you ever have you ever been able to get an approved loan for someone that's like totally paid on the table? Like I know some people that like only are paid in cash. And they're like, there's that meme I've seen on Facebook where like, you know, someone's at a car dealership buying the car and they're like, oh, we need proof of funds. And they just like fax them a picture of like $100 bills, you know, and it's like, that is not proof of funds. Like that's just proof you have money right now.
Yeah, right.
You know, like, it's obviously a joke, but.
The thing that I have, and I'm creating a YouTube video about this for my channel. So because people get a lot of the questions, you know, from underwriters about, oh, well, why do they need this? Well, why is this so important? It's like, okay, well, let's flip the table around. You're about to lend someone $500,000 out of your own pocket. How much research are you going to do into that person? How much verification are you going to run through on that person to make sure that you're gonna get your money back?
And sometimes they want the property inspection too. They want to know that the asset's actually worth that much.
You're gonna send out an appraiser. You're going to call their employer and make sure that they're legit. I haven't seen them personally, haven't had clients do it. It's kind of a rare thing, but you can absolutely forge pay stubs. Sometimes I look at those, I'm like, that really doesn't look very difficult to create in Canva or on my own, you know? But that's why not only do you have to submit pay stubs,
Photoshop, and I can.
There you go. Make it look like you make $1 million.
Yeah.
But that we call the underwriter, the lenders call your employer right before you close, make sure that you still work there and you're not like, you didn't get fired a week ago. Things like that. But if you were the one lending, again, $500,000 of your own money,
they want to make sure you can pay back $1 million over the next 30 years.
Right. Well, I mean, if you're going to be lending money, you want to make interest on that money.
Of course.
But
yeah, and then if something does go wrong, is the property actually going to be able to be worth something if they have to repossess it?
Yeah, if you're going to be able to, is your money secured? So like I'm working on starting my own hard money lending company with some partners, right? So the whole underwriting process is essentially, and this is for like fix and flip loans for investors, but it's going to come down to how much is the asset worth right now as it stands? Because you're probably buying a distressed property, needs some work. You're going to put some money into it, force appreciation, and sell it for a profit, right? How much is it worth right now? How much is it going to be worth when you have it fixed up? And do you have that number accurate? You can tell us what you think, but we're going to do our own verification on that and whether we agree with you or not. And we're going to base our numbers off of mostly what we think, hopefully, you know? unless you have some good evidence on the contrary, right? But we're going to verify that. We're going to make sure that, because not only us, but our investors, the investors that are actually pooling the capital that we are working on lending, we need to protect them. We have fiduciary responsibility to everyone involved.
They're trusting you that you're going to make sure that you're only giving loans out that they're going to get paid on.
Yeah, right. They need to make sure they get paid back. And you don't want to end up getting I've seen multiple investors too that end up underwater on some of these houses that they've tried to flip. They're like, they bought it, they thought it was a good deal. Yeah. I've seen, and then they've come to me before. They're like, oh, well, can I cash out refinance on this? I'm like, you owe 120,000 or 120% of what the property's worth now.
Yeah.
Like, we're not gonna be able to do that, unfortunately. Like, it's not 2008 anymore.
Yeah.
But it totally can happen.
Stated income loans.
Yeah. But then that lender that lent them the money lost money. Their equity partners that gave them money for like the rehab, they lost money. The individuals lost money.
Yep.
People just lose money. It's not,
people are going to not trust you anymore.
But then that investor is going to have a hard time getting money later for future projects.
Yeah.
So you've got to make sure that your numbers are good. And, but all that to be said, everyone wants to make sure that everyone gets paid back, because you don't want to end up with, that on your head, and the lender doesn't want to end up with a headache and losing money either.
Yeah.
There's lots of verification that goes on when you're dealing with hundreds of thousands to millions of dollars. Yeah.
Can I tell you something that frustrates me as an insurance agent? So people will buy a property like Alpine, Utah, built in 1935. Mm-hmm. It's like a 2-bedroom brick cottage on like 5 acres. And so they get a loan, right, that their property's worth like $1.8 million because it's 5 acres of prime Alpine real estate. Yeah. But the house is only worth like $300,000. And then the lenders, they send me an insurance request and they get pissed because I'm like, this policy's only written for $300,000.
Yeah, property.
And they're like, well, the land's worth, the loan they have is this. We need it to at least be the loan amount. I'm like, if that house burns down completely, we're not paying them $1 over $300,000. I could write the insurance for $1 million. Mm-hmm. But why? Like, there's no reason. Yeah. And so they want me to like give proof of the value, because usually it's a purchased loan, right? So they don't have the original stuff from the other lender, or they don't want to verify it or whatever. And so I sometimes had to argue with mortgage companies that are trying to get me to increase the insurance value because it doesn't match the loan amount. And I'm like, just because insurance companies don't insure land. Yeah. Right. We
try burning land down to the ground.
Try burning. Yeah. Even you can, but
you could try.
It's still relatively usable, right?
Yeah. Like, you're still getting the
real
space.
Estate land. Yeah. So it's kind of funny to me, and I have to deal with that all the time. Where it's like
that's wild.
3 or 4 times as much insurance.
Yeah. We always have to get like a estimated value of the structure.
We call them RCEs, replacement.
Yes, replacement cost estimator. Yeah, there you go.
RCE.
Yeah, so we always have to get those. Every lender asks for them now. Yeah, every single one.
Well, and what's annoying is there's some insurance companies that have started changing their guidelines to where they're not allowed to share them with lenders. Yeah, they like literally put a little like paragraph at the bottom of the replacement that says this isn't to be shared with lenders. This is not suitable for blah, because this is just a best estimate, because they use Xactimate or whatever. 360 value, whatever the Xactware, the different softwares they use it. But because it's like, well, we don't want someone to say that we're liable for saying the condition is right. And that's, I think, what the insurance companies are worried about. It's like, well, if we think it's worth 400 and it actually is 500, like, is the lender going to try to sue us saying you think it's worth? Anyways, I don't know why they're doing it, but
that's wild.
Yeah, that happens sometimes.
Interesting.
Too, so. Yeah, only a few carriers do that. But I imagine it'll become more common as they're like, no, you need to decide that. Anyways,
it's interesting watching insurance companies and mortgage companies go back and forth and fight and
Well, here's the worst thing. This is something I really hate. So we have most people, their insurance is escrowed, right? Like you're talking about, like, so you got your taxes, you've got your mortgage insurance. If you've got mortgage insurance, usually if you put under a 20% down payment, and taxes. So
we can talk about that.
Taxes.
I have thoughts about mortgage insurance.
Yeah, that'd be great. Continue. That'd be great. But some people don't escrow their insurance and pay it themselves. No. Well, oftentimes when loans get sold, the insurance agent gets a form from the new mortgage that says, hey, we've updated the mortgage. Here's the approval notice, right? They have all the paperwork line, and there's a little box that literally says escrow yes or escrow no. Yeah. And they always mark it yes, period.
Every time.
Like they don't even double check it. They don't even verify. And so we have people that'll call and they're like, hey, my insurance policy's pending cancel because my payment didn't go through. I'm like, oh, the payment never was requested. We didn't charge you or anything because the mortgage company send us a note saying it was escrowed now. And they're like, well, it's not escrowed. It hasn't been escrowed for 20 years. Yeah. And it's like, well, you need to call your mortgage company and have them, like, we can change it, but the mortgage company will just keep sending us the notice until you talk to them and tell them to hey,
figure it out.
it happens to some, like we have some people that they refinance all the time. And so it happens every time they refinance, we have giant notes on their file. Like, do not change this off of mortgage, off of non-escrow. Like the client pays this just because they've done it 5 times in the last 7 years. And every single time they've tried to change it. And it's like,
wild,
anyways,
dude.
Let's talk about PMI.
Yeah. Oh my goodness. Okay. I have
The
thoughts.
pain of PMI.
I'm curious what you have heard about, or what your opinions are of mortgage insurance.
So mortgage insurance, PMI, it's the only insurance that you pay for that does not benefit you at all. It covers someone else, right? Like you're paying insurance for the mortgage company or the lender if you default on your loan. That's my understanding.
Oh yeah, yeah, pretty much. I mean, it's it's an insurance policy that's force placed essentially, and it's at a set rate depending on the type of loan that you do or whatever. So like FHA, for example, is set at 0.55% of the loan amount per year.
Oh,
so it ends up being a few $100 for like an average priced home here in Utah. Yeah. But unless you put more than 10% down, you can get it like 0.5%, but whatever. So it's still a decent amount, but conventional loans, those ones depend on your credit score and how much you put down.
And they pretty much want you to have at least 20% equity in the property to not have the vendor.
So that's, PMI, right? So that's this is another question I get a lot too, is on like, hey, when is my mortgage insurance going to go away? So, okay, what type of loan do you have? If you have a conventional loan, yes. Once you hit 20% equity, you can request to have the lender remove it. Usually you've got
off, right? At like 22% or something.
Yeah. So at 78% loan to value or 22% equity, it automatically comes off. But that is when your loan has been paid down from the original balance, from like your original loan to value. That doesn't really take into consideration property appreciation.
If your property appreciates 15 or 20%, or like my first property,
it's not going to fall off automatically.
It went up 50% in value the year after I bought it.
But then you can go to the lender and request it, but usually you'll have to get an appraisal done to verify that now you really do have that much equity in the property. And then you can request to have it removed, right? FHA though, it doesn't go away.
Period. You have to refinance.
You have to refinance to get rid of it. Unless you put 10% down, then it goes away after 11 years. But
most people refinance by that point anyways.
Right. So really essentially in intents and purposes, it's for the life of the loan, and it's 0.55% generally. So, but I've had lots of people call me and they say, well, I just hate mortgage insurance because I think it's a waste. I'm like, is it? Well, yeah. Okay. Yeah. Maybe, but so to get rid of mortgage insurance though, to get rid of it, you have to put 20% down.
Yeah.
Okay. Where's your 20%? Okay. If you don't have it, you have to, so really all it is, cause it used to be, this came about in, I want to say it was like in the 50s, somewhere around then, that you couldn't buy a home. You couldn't get a mortgage unless you put at least 20% down. Mortgage lenders didn't offer anything unless you put 20% down. And then it started to become, that was a problem.
70s?
I want to say it was in the 50s when this started to be an issue. And that's when mortgage insurance started to become a thing. And it was less of a general, like an established, regulated sort of thing like it is now. But they made this option and said, okay, because when you put less down, there's more of a risk to the lender.
Risk. Yeah, of course.
There's more risk.
You have less sweat in the game because if you default on a loan, they just immediately made 20% equity. Of course, they're willing to take a little bit of risk. But if you're putting 0% down, all the risk is on them.
Yeah, and you have no skin in the game, sort of thing.
And the cost of repossessing a home is
expensive, way more than you would think.
It's more than you,
So they created this option for mortgage insurance. You put less money down so that first-time home buyers would have more options. And so it was, hey, you can put less money down. You don't have to have the full 20%. You can put 5%, 10%, whatever. But then we'll just add this mortgage insurance. And realistically, if you're putting 5% or more down on a home on a conventional loan, it's not that much. Less than $100 a month. You'll pay more on your homeowner's insurance than you will on your mortgage insurance. The only time the only time it's really expensive and significant, couple $100 a month, is if you're putting less than 5% down, or you do like an FHA loan, right? So I have this conversation with clients. It's like, yeah, we don't love mortgage insurance. We don't really like that idea. I'm like, well, but how long is it going to take you to save that 20%? How much equity and appreciation, especially in Utah, that is very much an appreciation. There's a difference between real estate markets, macro, microeconomics, the appreciation of homes varies wildly depending on where you're at in the country, right? But here in Utah, very much an appreciation market. We've seen that over the last few years. How much equity are you going to lose out on by not purchasing the property now, putting a little bit less down? I guarantee you it's going to be less than the cost of what your mortgage insurance was. Couple $1,000s a year, maybe,
and then you can
on mortgage insurance. You refinance later, get rid of it in a few years, but then you'll be able to capture all that appreciation. What average right now, 3 to 5% per year? Guarantee that is quite a bit more than your less than 1%, something less than 0.5% per year on your mortgage insurance. So don't hate on mortgage insurance. It does
so you can
suck.
buy a property without 20% down.
Yeah, it makes you so you can buy a property, man. It's awesome. I don't know. Nothing I'm like,
unless you want to go sell or finance it and figure that out.
All right. That's an interesting, that's something I'm not an expert in, but I want to be. Like, it's seller finance.
We can get into that sort of thing, and it's really, really cool to talk about. I think seller financing is just the most fascinating thing. Right. It's avoiding the traditional institutions.
Yeah, totally. Totally.
Yeah, you have to have the right person for sure.
But yeah, you don't have to put 20% down on a property. There are plenty, I get this question a bunch too. Every single loan product that I have access to as a broker, and I have a lot more than just the conventional FHA, VA. I could do bank statement loans, jumbo loans, which are above what's called the conforming limit. What's
the conforming limit?
A little over 800,000. Now it's been going up, which is so funny. When I first started in this industry, it was, or right before I started, the year before, it was like
550 or something.
It was like 500,000, and then it jumped up to like
every
650.
House is a jumbo loan now.
And then it was 700, and it was high 700s. Now it's 800. Anyway, It's jumped up a ton. But anyway, for a primary residence, if you're going to be moving into the home and it's your primary residence, every single loan option you can put less than 20% down. A lot of them are, some of the bank statement loans or things like that for self-employed people, it's 10%. But if you're doing a conventional or a normal typical loan, which for 90% of home buyers, that's what you're going to do. Yeah. 3%
Every
minimum.
Property I've bought has been conventional.
Yeah.
I've never done an FHA or DA or VA or any of the other stuffs. And
a lot of those are similar as far as, what their structure and everything. But yeah, I mean, you can do much less than 20%, 5, 3, 3.5, sometimes 0% down. Done plenty of those too. So there are lots of down payment assistance options, things like that.
What sort of things exist that help people get lower? Because most people kind of have the idea you need at least 5%. Like I've had people, actually had someone message me like 2 weeks ago being like, hey, I thought you had to have 5% down to buy a house. Like we're thinking this is how much money we need. And I'm like, go talk to a loan officer. Like, trust me, there's a way. Like, what are some of those options, or I don't know?
Yeah. So, I mean, we've got probably the most popular ones here in Utah. So Utah Housing is Utah Housing
UHA,
Corporation.
Or UHC?
UHC. Yeah. So they have what's called the Utah Housing. They have a couple different options, but they've got down payment assistance programs for existing homes. That is you can get up to 6% of the purchase price in a second loan that you can use for the down payment and closing costs, et cetera. Okay. And then they also have for new builds, for new construction homes that are below $450,000 purchase price, you can get a $20,000, and it's not a grant. This is where people get so confused. It's not free money. That you can borrow this $20,000. It's 0% interest. There's no loan payment on it, so you're not making a monthly payment, but it's not free either. They don't just give it to you. It's not a grant. You either, when you refinance the home or you sell it, you have to pay back either the lesser of either the full $20,000 that you borrowed or half of your equity. So if you have less than $40,000 in equity, you just pay half of whatever your equity is. But if you have more than $40,000, then you pay max $20,000, but you pay it back to Utah Housing.
Let's be honest, when will that ever happen? It's going to end up being 20. Most situations, it's probably not worth refinancing if you only have that much of a difference. Yeah. So that's less than 10% of appreciation. Well, not 400, but
yeah. So, but it's not a grant, but you don't have a payment on it, which is nice. It's for new construction homes. So that's an option. You can get that. And then we've got lenders with other like proprietary down payment assistance options and products. So you can get similar 3.5%. Like if you're doing an FHA, they'll give you enough for the purchase price, but you've got to bring closing costs or get seller concessions to cover it. Or you can do 5%. Which is
very common in this market.
Super common right now.
Get seller concessions.
Yeah. So I've got an offer in on a house right now. We're buying our first house, hopefully. We got an offer. We'll see how it goes. we're asking 3% concessions. I've got a client that just got 3%. I've had clients get upwards of $30,000 in concessions.
Well, my brother, brother-in-law, when he bought his property, they got concessions for replacing the roof and putting in a radon mitigation system because it needed it.
Man,
obviously they had to do that to close, but they're like, we can do it as a closing reimbursement instead of having to do it before we can sell the property and stuff like this. Way better. So it was a lot. It was like $30,000 or something like that.
Yeah, everything's negotiable when it comes to real estate. Yeah, my favorite real estate agents always say that, like, everything's negotiable. Everything. So, but yeah, I mean, there are a ton of options that, and I have this conversation because I have clients come to me that say, hey, we heard about the Utah housing thing. Can we do that? Can we look into that? Absolutely, we can look into it. Probably not going to be your best option though. So like this one client that I've got right now that we talked about it. They were like, oh, can we get that $20,000 grant? Like, well, it's not a grant. It's not free money. You've got to pay it back. But also in combination with that, you've got to use Utah Housing's loan. And
the terms
the
might not
rates,
be as favorable.
Yeah, the rates are a little bit higher. Things like that. So they're great for people who need them, for where it's like, yeah, we really have no money down, but we really want to get into a home. Great.
That's
like we have the option. Yeah. But it's a great option for those people.
For someone that needs it.
But if you can bring your own down payment, if you've got enough money to put down on the property and keep a little bit of savings in the bank, don't spend all of your money and put every dime you have saved into the down payment of your home, because inevitably your water heater is going to break the week after you move in. Something like that. But if you can bring your own down payment, you get the options open up way more to you. You get way more favorable terms on your loan, better interest rates. If you're doing a conventional loan where the mortgage insurance varies, you get better mortgage insurance. It's just way, way better. And in the long run, because then if you want to refinance, you have a little bit of equity in the home, right? If you went and got a second mortgage, down payment assistance program, you don't have any equity. So even if rates came down, you're gonna have a really hard time refinancing. And you're not gonna be able to take advantage of lower rates and get your payment down.
Interesting.
But you can if you've put your own down payment. FHA, we have an option that we don't have to do. You can it's called streamline refinance on an FHA. No appraisal, no income documents. It's literally just for the purpose of reducing your interest rates. And there's another option with VA that's super similar called
So it's basically just saying, using your original terms, if we were to requalify that same loan today, what would the interest rate be? And you can just streamline that.
Essentially,
it's more complicated than that. I'm just.
But so it's like, hey, we know that you qualified for this loan previously. We know that the property appraised for that. We are just going to, let's just restructure your loan and refinance it to the lower interest rate of today to lower your payment. You qualified for it then.
Closing costs too?
Yeah, the closing costs are quite a bit cheaper. So you usually underwriting fees are half, so they're much, much cheaper.
Oh,
wow. So they're cheaper loans to do. They're much faster and you're not paying for an appraisal. No, you're not sending income documents in. The only thing you have to do is send in your mortgage statement to show, and also a credit report. We'll get a credit report to show that you have made on-time payments for at least the last 6 months. You have to have had the loan for at least 6 months to do it, but you've got to make on-time payments. If you've had it for longer for that, 12 months, you got to have on-time payments for at least the last 12 months. And then we just refinance and lower your rate.
That's cool.
It's awesome.
Especially especially a lot of people that got their loan in the last year and they're like, 7% or 7.2 or whatever. Yeah,
I've got,
hey, interest rates are like just below 6 right now or whatever.
Yeah. Oh, for FHA and VA, where these ones you can do these streamlined refinances, if you have an interest rate above 6.5% right now and you've got a decent credit score, we're getting people down
Call
usually
Josh.
into the 5s. So
info's in the description.
So yeah, it's awesome. It's a great product and great option for a lot of people right now that bought in the last few years.
Okay, here's a weird one I've heard. I've heard that certain types of loans only apply to certain geographic areas. Like you have to be west of a certain river or something weird like that. Like,
there's one loan that's pretty prevalent here in Utah just because we have a lot of rural areas.
We're Utah.
USDA.
Rural. That's it, USDA.
Yeah, so that is one that USDA, the United States Department of Agriculture, right? That's who guarantees these loans. But it has to be within an area that they have deemed by survey as a rural area.
Okay.
So it used to be that like Eagle Mountain and Saratoga were rural up until like 2023.
Really?
And then now it got
there.
cut out. Yeah. There were some parts kind of along the Wasatch Front, parts of Spanish Fork, Payson, Sanquin. Now some of those have been cut out. I think Payson and Sanquin still are, and like Nephi is eligible, but now Spanish Fork, Mapleton, those places have been cut out, unfortunately. If you come closer to the lake though, like some of those smaller towns, Genola, yeah, Palmyra, whatever else is over there. Yeah, those are those I think are still eligible as well. But yeah, so if you're in a rural area, you can get a 0% down loan on those homes. There's other nuances to it. There's still debt to income ratio requirements and credit requirements.
It's probably still better to put. Could you still do a USDA loan even if you are putting money down? Or at that point, it's probably more favorable to just get a conventional loan.
Yeah, well, yeah. So USDA, they do have some stipulations that if you, because it's made for people who don't have the money to put down essentially, or, you know, don't have a whole lot. So you can't do a USDA loan if you are putting a certain percent down.
Oh, interesting.
It becomes ineligible. You've got to go a different route. But yeah, usually it's like at that point, you might as well just go conventional or something like that.
Yeah, that
but,
makes sense.
So,
that makes sense. Moral story is ask Josh.
Yeah. I got you.
This is cool. Like,
That's what I'm here for.
Talk about, right? It's like the point is to recognize there are options. Yes. Some people don't think there are options. They think they have to have certain hallmarks. And the goal that I want to say isn't that everyone that listens, obviously, right? We're not the experts. We don't need to teach this all day, but it's realizing the options there, and you just need to talk to a trust professional. I could say that all day long. Just talk to a trusted professional.
And it doesn't hurt to just talk.
Yeah.
Like I've had lots of conversations with people. They've reached out and said, hey, we're just curious. We're just curious. This is where we're at. We're thinking maybe in the next like year or two, but you don't know.
And then it works out. It's like,
until you talk to someone.
Now it's good.
Oh yeah. And I've had those situations before where it's like, oh wow, actually it's a lot easier to qualify than we thought, than we had in our heads.
Yeah.
Wow. Yeah. Maybe we should seriously look at buying because it's such a great time right now, or it's an opportune time, or just graduated college, whatever. Or
if not, you can help them make a path. A plan. Yeah. It's like, hey, you've got these certain things on your credit score that we need to get taken care of, right? You've got this sort of thing. Okay. Based on what you're saying and where you want to buy and what that, this is a sort of down payment. Now you have a concrete number. It's like, this is the sort of down payment I need to buy a house that's worth this much, right? If you point out houses you want, or maybe you can coach them as well. It's like, hey, the appreciation, expect these houses to be priced about this point next year. So here's the actual down payment you'll need, or blah, 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 right? Like, just here's the action plan to get to where you can buy the house. And I think that's so much better than just being like, I need 5%. And then finding out years later, you didn't need 5% and you should have bought back then and you could have. Just talk and get the plan created. And I think that's half the battle.
If you are interested in, you have any sort of plan to buy a home in the next 2, 3, 4, 5 years, just talk to a loan officer. Like, reach out, and any of them would be more than willing to just have that initial discovery call of where are you at right now, and does that fit your timeline, or can you qualify right now, and is that what you want? Do you want to wait a few years, or do you not quite qualify for how much you want, or the type of loan that you want?
Yeah.
Now let's make a plan of how to optimize your credit score. We've got a ton of tips and tricks that we teach people on that. We can get you connected with a trusted financial advisor to help you with getting a budget and saving, things like that, if that's your goal. And just like, let's just get you on the path. Let's just get you, if that's your goal, you need some clarity on your goal, or else you're in a much harder time getting there, right? Because you don't know where there is or how to get there. So anyway, I try and push people to do that all the time. I'm like, come on, just talk.
Budgeting and all that. I always tell people, it's like, if you don't have a reason to do it, you're not going to do it.
Yeah.
Right. Like, if you don't have a reason, it's like, who cares? As long as you're making your rent or your mortgage payment or whatever,
you're not going to feel it.
You don't you don't need anything. But if it's like, hey, I need this much money saved in a year to buy a house, and I can do that, it makes it so much more meaningful to be like, hey, I can skip out on this sweet treat for a couple of weeks or whatever 100%. It is, where I just get that extra money, or hey, I need a, shameless plug, shop my insurance and just make sure I'm paying good prices. I can put that extra money into there, or whatever it is, right? Maybe it's, I can reduce how much I'm putting into my retirement plan temporarily to get the down, or whatever it is.
100%.
It's easier to reach toward the goal if you have a goal. You need a reason to do it.
This is something I've thought a lot about. I heard this quote, and I don't remember where I heard it from, but it is applied to things just personally, with finances, with whatever, but especially with business. Like I've become like just like a business nerd and learning as much about just like running businesses and what goes into it, how to build a business, etc. And one of the things that I heard recently was fear isn't what, or lack of confidence is not what keeps people from moving forward and taking action. It's lack of clarity. Right? So like if you don't have a plan and you don't know what next step to take, or at least have an idea, you're not going to do it. If you don't have it mapped out, because you don't need 100% of a plan to get from here to there.
Nope.
Your plan's going to change anyway.
Yeah.
You need about 70% of a plan, maybe for most things. It's like, if I've got 70%, I'm pretty good. I can take some steps forward because my plan's going to change once I take a few steps.
Yeah.
I'm going to see what I can't see right now. So just, it's a lack of clarity on what that next step should be, not a lack of confidence, you know? So if you don't have clarity, then you're not going to do anything. So get some clarity.
That's awesome.
You know?
No, I definitely, that a lot of thoughts.
Yeah. We can do another
a whole
deep dive into someone else into that. Yeah.
Just mentality and how to think about things. Yeah.
That has been a huge game changer for me over the last like few years. I just, I grew up in a place where it was a very average suburban neighborhood and people just kind of lived the normal life of, go to school, get a job and make it to retirement, with some money in the bank, something like that. And none of that's like bad. Like there are some people that love, if you can, if doing that kind of thing, it works for you and you love that lifestyle because it gives you a lot of stability and, whatever. Awesome. But I've always been very ambitious. And so like, I'm kind of the black sheep of my family. And, like my dad's been doing this for a long, long time. He's been doing it for, 20 plus years. And so I got a little bit from him, I think, but breaking outside of that box. So Parker McCumber, so we grew up in the same neighborhood.
Oh, I didn't know
so
that.
I'm like great friends with his family. So there've been a handful of us from that neighborhood that have gone down this entrepreneurial path. But yeah, things like open up a ton for me after once I started into this and started meeting other successful entrepreneurs and just like the mindset shift of different. Holy cow, there's way more opportunity than we see right now. Like there's opportunity everywhere. There's opportunity that I'm not seeing right
everywhere.
Now, and so like, you just have to be open to it and meeting people and talking to people. Every time I meet someone new, it's like, oh, whoa, I didn't even think about that. As long as you're open to it, like people mind just like starts flooding. Yeah. Oh my gosh. With all the information and knowledge. So I love soaking all that up.
Yeah. Well, I always talk that one of the phrases I live by is your network is your net worth.
Yeah.
I think about that a lot. It's like, okay, how do you connect with people? Right. Because the more people, and that doesn't necessarily mean you have to connect with like ultra wealthy people. It's just more people.
Yeah.
Right. More. If I'm connected with 500 people, if I'm connected with 1,000 people over the next year, that's dramatically going to increase. And part of why it's important as well is to recognize the value of what you do and have faith in what you do. It's like, I provide loans. I provide clarity to people that help them make an action plan to get into a house. People that would have never bought a house if they didn't meet me have bought a house, right? Like that's sort of cool clarity. Or, right, I help people understand how their insurance needs to work to properly insure their house. So they know when something goes wrong, they're covered, right? Like giving meaning to what you do changes the way you approach it.
Yeah.
Right. And 100%. It's a little bit into mindset, but right.
Like,
because you can look at any job two ways, right? Like I'm here to get a paycheck and go home.
Yeah.
Nothing wrong with that. Right. But it's like, I'm doing good in people's lives. It makes it easier to wake up in the morning and get to work.
100%. 100%. Yeah. I mean, it just like gives you, and that thought of, because I think that everyone absolutely has value to give in other people's lives. Like there's a reason we're here on this planet. And it's not just to gosh, what is that quote? Most people tiptoe quietly through life to make it safely to death. I heard that quote for the first time and I was like, holy frick, like you're right. People are too scared to, and I'm not even talking about like business, whatever. I'm just talking about like living life and just getting outside of your shell a little bit and being willing to take a risk on a friendship, on reaching out to someone that maybe you wouldn't normally, or because some of the happiest people that I know are the people that have the most fulfilling relationships, because they put themselves out there, because they put themselves in front of people and they give of themselves to other people, and whether they get it back or not, but it always comes around, but anyway, just that thought and that mindset of being open to opportunities, being open to giving yourself, giving of yourself to other people, connecting with people, matter who they are. It doesn't have to be ultra wealthy, whatever. No, like anyone and everyone.
Yep. But I summarize that as this is my whole karma and do good.
Right.
I just say do good, be good, get good.
Get good. Yeah. Yeah. I love it. I love that.
Love it. Okay, we're kind of getting near the end on time here. So
100%.
I want to move. Thank you so much. This has been fun. This has been good.
Fun, really fun.
We'll have to do it again. I say that to like everyone because it's just I just find it one of the reasons I selfishly wanted to do this is, I mean, obviously, I like to connect with people. Yeah. It's brought like some of the greatest referrals for business I've gotten have been from people that I've interviewed.
Yeah.
But it's also like selfishly, like I like to continue learning and get out of my comfort zone and be uncomfortable. Let me tell you, doing this podcast has been very discomforting because it's like, I have to talk to people and I have to find and find useful things for people to, I don't know. I really like all that. And so thanks so much for coming on.
Yeah, I super appreciate it. It's been awesome.
Fun. Okay. So I end with a segment called Ask Jacob. Okay. And this, it's just where I take questions that people have sent in and, or that clients of mine have asked me recently and answer them. So I'd love to get your thoughts on this too. Yeah. But so here's the question of the week. Segment 5, Ask Jacob. What happens when your car gets hit? So I have a car with liability only that got hit in a parking lot. Unfortunately, my car's liability only. Doesn't my uninsured motorist insurance cover the damage? There we go. I'll start off if you don't mind.
Yeah, no, I don't know. I'm curious to answer this question.
So liability only. There's two types of auto insurance you can have. One that people usually have on newer cars is called full coverage, which is a misnomer. We don't call that in the insurance industry. Full coverage usually means you have comprehensive and collision. Comprehensive is like theft, a hailstorm, tree falls on your car, that sort of thing. Hitting a deer technically falls under comprehensive. And then collision is your normal car accident. So if you don't have those two things, you have what's called liability only. And liability only is to cover the liability you caused other people, right? To legally drive a car, you have to have liability insurance. That doesn't protect you at all. No. It protects the other person, protects the car you hit, protects the person you injure, right? So if you have a liability on your car and it gets hit in a parking lot, right? Hit and run, like it sounded like this person that emailed me said, it's likely you have no coverage at all. That's one. So she mentioned her uninsured motorist insurance. Does uninsured motorist insurance cover the damage? There's two types of uninsured motorist insurance. One of them is medical liability. So UI or UIM, if you look on your insurance policy, it'll say UI, UIM, or uninsured, underinsured. That's medical liability. So what that means is if someone hits you and they don't have insurance, which obviously they should, but some people don't have insurance, your policy covers your medical bills as if they had just as good of insurance as you. So if you have 50,000 medical per person, 100,000 per accident, someone hits you that's uninsured, your policy, if they don't have insurance, would pay $50,000 for your medical bills, or 100,000 total if there's multiple people in your car, but your car's not covered. There's an optional coverage beyond liability. Sometimes I call it liability plus, called uninsured motorist property damage, UMPD, but it's usually not that helpful because usually those policies only provide like $3,500 of coverage. So it's not a lot, but it's nice you have an old junker car that you're like, well, I want a little bit of coverage on this, but it only is going to apply to an uninsured motorist or a hit and run, right? Like other than that, you might be So unfortunately, my answer here is no, your uninsured motorist insurance doesn't cover the damage because that is for medical liability. Yeah. If you're liability only, right, then you're kind of shit out of luck. But it's usually not a big problem because usually if you have an old liability only car, it's because it's an old liability only car, right? Much, like when you're 15, 16, brand new driver gets a car, give them a junker crap car because it's cheaper to insure.
Right.
So anyways, I don't know. That's my thought on it. You have any thoughts, questions?
No, that's super interesting. I didn't know that. That's good to know.
Yeah. A lot of people are like liability. People don't understand what the word liability means, right? Liability is not to protect you. No. It's to protect other people. Yep. Well, when it comes to car insurance, your homeowner's insurance has liability insurance that protects liability again that you cause other people. It's not paying. So same thing.
Yeah.
Yeah.
Still other
Liability
people.
insurance isn't. It's almost like mortgage insurance.
It is.
Right.
It is like other
You're
people.
paying for something that doesn't protect you. It protects the mortgage company.
Yep.
In this case, your liability insurance protects other people you injured and doesn't protect you. So
Yeah.
There
Totally.
you go. Sad answer.
Interesting.
If you have insurance questions that you want answered, email me, thefinancialginger@gmail.com, and I'll answer them on the podcast.
Let's go.
Cool. Okay. Well, we'll take it back to you for a minute.
Love it.
If someone listening and they're like, oh, I definitely need to check my loan options, or they've just resonated with what you said, how can people get a hold of you? Obviously, we'll put it in the contact, we'll put it in the description, but
yeah, for sure.
verbally.
Yeah. So I've got a website that you can check out, which is utahcountymortgage.com. It's for me and my dad. Our team is on that. And then my Instagram, I'm pretty active on social media. So, and I'm starting a YouTube channel soon. So
Sweet.
I'll have that up and going. But my Instagram is just the Josh Duke.
The Josh Duke.
Yeah. It's I got the little blue check mark verified.
Oh, nice.
Yeah. So
I don't even know if I have that.
but so that's I'm on Instagram super often. You can shoot me a message there anytime. And that has some of my other contact information you can get there too, like my
and the website
cell
is
and
Utah
email.
County Mortgages.
utahcountymortgage.com. Yeah. Yep.
Okay, cool.
Yep.
Cool. I'll put it in the description so you guys can check it out.
Social media is probably like the best places where I'm most active on like
That's
Instagram.
funny. That's your website. Our my email, the old office email before I got the ones I used was Utah County Insurance. Was like the name of the
That's
company.
funny.
It's changed now, but yeah, that's funny.
That's awesome.
Utah County Mortgage.
Yeah.
Well, cool. Well, thanks so much for being on.
Dude, I
super
appreciate it. It was awesome.
Party.
Thank you.